JP Morgan downgrades Tesla, beginning of the end. That headline just moved markets. Tesla shares dipped, Twitter erupted, Reddit went to war. But before you panic sell or buy the dip, stop, because today we're not just talking about Tesla, we're talking about the machine behind that headline, the system that decides what a stock is worth, who benefits from those decisions, and, most importantly, whether you should actually trust it. By the end of this video, you'll understand exactly what a JP Morgan downgrade means, how capital markets actually process that information, and why some of Wall Street's most confident calls have been spectacularly, embarrassingly wrong. Section 1. What is a downgrade really? Let's start at the beginning. When JP Morgan, or any major investment bank, issues a downgrade, what are they actually doing? Every publicly traded company is tracked by sell-side analysts. These are professionals employed by investment banks whose job is to publish research reports on companies, models, forecasts, earnings estimates, and assign one of three ratings: buy, hold, or sell. JP Morgan uses the language overweight, neutral, and underweight. Underweight is their version of sell. When they downgrade Tesla, they're moving it from one bucket to another, and simultaneously updating their price target, a 12-month projection of where they believe the stock will trade. Here's the critical context on JP Morgan and Tesla specifically. Analyst Ryan Brinkman, who leads JP Morgan's Tesla coverage, has maintained an underweight rating since February 2015. That's not a recent alarm bell. He held that position without interruption for more than a decade, not wavering when Tesla surged to a record high in December 2024, and not upgrading when shares bounced off 2025 lows. His thesis has been consistent the entire time. Tesla is overpriced relative to its automotive fundamentals. So, ask yourself, if the same analyst has been bearish for over 10 years, is this downgrade news? Or noise? Section 2. What a price target actually means mathematically. This is where most retail investors get lost. A price target isn't a prediction pulled from thin air. It's the output of a financial model, typically a discounted cash flow analysis or a comparable company valuation using multiples like price to earnings or EBITDA. Here's how it works. An analyst projects a company's future cash flows, say, 5 to 10 years out. They then discount those future dollars back to today's value, because a dollar earned in 2030 is worth less than a dollar today. The rate they use to discount, the discount rate, is partly science, partly judgment. Tweak it by even 1 or 2 percentage points and your price target swings by several dollars. Now here's what makes Tesla especially difficult to model. Analyst price targets for Tesla currently range from $125 at the bearish end all the way to $600 at the bullish end, reflecting deep disagreement about the company's future. That's a $475 spread on the same company. JP Morgan's price target of $150 implied more than 34% downside from Tesla's price at the time of their April 2024 call. And yet, even at that target, they acknowledged Tesla would still rank as the world's most valuable automaker. Section 3. Institutional versus retail. Two different games. Here's something they don't tell you on CNBC. When JP Morgan publishes a downgrade, who is actually reading it first? Not you. Not me. The primary audience for sell-side research is institutional investors, pension funds, hedge funds, asset managers with billions under management. They receive these reports at 6 a.m. before the market opens. By the time it's a headline on Yahoo Finance, institutions have already acted. This creates a structural asymmetry. Analysts face intense pressure because they have close relationships with the companies they cover, and they're seen as having a direct influence on share prices. Institutional clients use downgrades as one signal among dozens. They pair it with their own models, macro data, and positioning. Retail investors, by contrast, often react to the headline alone. There's also a herd dynamic at play. Analysts often appear blind to developments long after they occur, and after they are already reflected in share prices, and there is a structural tendency to stay within consensus rather than break from the group. The penalty for being wrong alone is far greater than the penalty for being wrong with everyone else. Section 4. How to read a research report yourself. So if you can't blindly trust analyst ratings, what can you do with a research report? Quite a lot, if you know where to look. Step 1. Skip the rating, go straight to the thesis. The first page contains the 2 to 3 core reasons the analyst is bullish or bearish. Evaluate those reasons on their own merits. Step 2. Check the price target history. Most financial sites like Benzinga or Bloomberg track every price target change over time. JP Morgan's Brinkman cut his Tesla target to $120 from $135 in March 2025, implying shares could fall nearly 50% from price at the time. But if you tracked his previous targets, you'd see a consistent pattern. Step 3. Note the conflicts. Large investment banks have underwriting relationships, trading desks, and advisory roles with the very companies they cover. These are disclosed in the fine print. Always check whether the bank has a financial relationship with the company being rated. Step 4. Look at the consensus spread. When price targets range from $125 to $600 on the same stock, that spread itself is the signal. It tells you the company's future is genuinely uncertain and nobody, including the professionals, has a reliable model. What does that repricing actually look like? JP Morgan's current price target on Tesla is $145. Analyst Ryan Brinkman's thesis is that Tesla trades at over 200 times trailing earnings, and the robotaxi, AI, and robotics revenue the valuation demands has not materialized at scale. At $145, that's not a collapse. It's a brutal compression of the premium Tesla has traded at for years. Think of it this way. Tesla at $145 is still a massive company. But Tesla at $145 would represent the market finally pricing it as a great automaker with promising side projects, not as the next Apple, not as an AI company, not as a robotics platform. That repricing, from visionary premium to fundamental reality, is what's potentially beginning. And that gap, between where Tesla trades today and what its actual cash flows support, is where the real risk lives. On the day of this downgrade, the stock barely moved initially, but by the close, it was down 2.15%. That's not catastrophic, but it's telling. Watch what happens over the next several days to weeks. Specifically, watch the trading volume on down days. Heavy volume on red days tells you institutions are distributing, selling into any bounce. Light volume on down days is far less alarming. It suggests retail selling without the big money behind it. The distinction matters enormously for where this stock goes next. The 13F. Your early warning system. Now here is the most important piece of intelligence you can arm yourself with as an investor. Something most retail investors have never heard of. Every quarter, the SEC requires any institutional investment manager with more than $100 million in assets under management to file what's called a Form 13F. It's a quarterly report listing all equity assets under management, every major long position, the number of shares, the ticker, the issuer name. These filings are due within 45 days of the end of each calendar quarter, and they're publicly available for free through the SEC's EDGAR system. What that means in plain English, 4 times a year, you can see exactly what the biggest hedge funds, pension funds, and asset managers in the world owned in the prior quarter, and you can compare it to what they owned the quarter before. Tesla currently has over 4,300 institutional owners and shareholders who have filed 13F forms with the SEC, collectively holding over 1.5 billion shares. Major names on that list include Vanguard, BlackRock, State Street, and JP Morgan itself. Here's why this matters right now. The next round of 13F filings will cover Q1 2026 positions, and they're due by mid-May. When those drop, pay very close attention. If you see a major hedge fund that has held Tesla for years, quietly exit their entire position, or even cut it by 30, 40, or 50%, that is a signal that goes far beyond one analyst's price target. Why? Because large institutions don't exit quietly by accident. When a fund that has held tens of millions of Tesla shares for years decides to leave, they're not reacting to a headline. They've done months of work. They've stress-tested the model. They've decided the risk-reward no longer works at any reasonable price. And here's the domino effect. When one major fund exits, other funds that track institutional positioning notice. It creates a cascade. More selling follows. The stock finds a new, lower equilibrium. One important caveat: 13F filings don't tell the whole story. Funds are only required to disclose long positions, not short positions. A fund could be simultaneously adding a large short against Tesla while their long position looks unchanged on paper. Keep that limitation in mind. But as a directional signal, especially for a stock like Tesla, where institutional positioning is enormous, 13F filings are one of the most valuable free tools any retail investor has access to. Use them. The bottom line: the JP Morgan downgrade isn't the end of Tesla, but if the 13Fs this quarter show major long-term institutional holders reducing or exiting their positions, combined with heavy volume on down days, you will have your answer about whether this repricing has legs, or whether this is just another dip in a decade-long story. That's how you read the capital markets. Not the headline. The underlying flows. If this gave you a new way of looking at how Wall Street actually works and you would like to see more of it, please hit that like button, subscribe, and turn on the notifications tab. It genuinely makes a difference. This is a brand new channel, and I want to be upfront with you about who I am. I'm a former stock and bond broker with over 15 years of experience. I worked for 2 top-tier investment banks on the West Coast before I retired, and I spent my career inside the very system we've been talking about today. I'm not here to sell you anything. I'm not here to give you hot tips or tell you what to buy. What I want to do, what this channel is entirely about, is give you the kind of insight and background on capital markets that most people never get access to. The stuff they teach you on the inside. Because here's what I learned after 15 years on the desk. Finance is not as complicated or as intimidating as Wall Street wants you to believe. There's nothing to be afraid of. And the more you understand how the system actually works, the better decisions you'll make with your own money. That's the mission of this channel.